This week in the Boardroom, brought to you by corporate board member and host NYSE Euronext, along with governance knowledge partners, the Center for Audit Quality, and Grant Thornton, and contributing partners, National Investor Relations Institute, and the Society of Corporate Secretaries and Governance Professionals.
Welcome to this edition of This Week in the Boardroom. I'm TK Kerstetter with corporate board member, and it's my pleasure to welcome my co-host, Scott Cutler, the Executive Vice President of the NYSE Euronext. And I'm not sure that I should introduce you as my co-host. You've been on the road so much that nobody's seen you for a while. So sure. I'm going to call you my guest today, and particularly in light of the fact of what we're going to do with our topic. Because the fact that we're the heartbeat or the epicenter of the capital markets, and we've never really addressed that on the show, sort of shame on us, but we're going to take care of that today. And who better to talk about that stuff?
I don't know about that, but I'll give a perspective.
Okay. Well, again, our topic is what board members should know about the capital markets. And Scott, it seems like a basic question, but really it's sort of a little more challenging when you say, if I were to ask you, okay, what are the three things that board members should know about today's capital markets? How would you answer that question?
I'd agree that it's a lot more challenging an answer than it has been in past years. The three things that I think are important are, number one, understanding the complexity, and number two is maintaining flexibility, and three is the importance of credibility. And so let me just address each one of those in fashion. One, understanding the complexity. The capital markets today are amazingly complex. If you looked at the 30 companies that trade on the Dow, there are over 20,000 other products that are linked to just those 30 stocks. And so it's equities, indexes, futures, ETFs, it's fund flows, different types of fund families, derivatives. There's an incredible array of financial products that are now linked to every types of security. And I think as you look at that as a mosaic and layer on top of that current equity market structure as an example, there are 40 different pools of liquidity that where stocks can trade in the marketplace today. And so why I say that you have to understand that complexity is that you have this wave of trying to understand and communicate better with your shareholders. But as an issuer, as a company, you probably have less visibility into who those ultimate shareholders are than maybe ever before. And so we can dig down a little bit deeper. But I think as a board member, I think number one, you just need to understand the complexity. Number two is really understanding flexibility. And this is applicable for small companies as it is for the largest market cap companies. And that is, a company today has to be able to maintain an incredible amount of flexibility for its own financing needs. Short-term capital, equity and debt financing, and be in a position to either have the relationships and have the system set up so that a company can tap those sources of capital anytime they need. We learned this in the financial crisis when short-term capital dried up and huge market capitalized companies faced short-term cash constraints where there was questions as to whether or not they were going to go out of business, and these weren't just the large financial institutions. So there are lots of different ways that companies are now addressing that need for financial flexibility. We, for example, just launched something last year called the Receivables Exchange, which gives essentially electronic platform for the trading of receivables, all the way for companies to manage short-term cash. The last point is just really the importance of credibility, and this really goes to board and its relationship with shareholders. Companies have to be able to maintain a level of credibility with shareholders in the market in order to be able to go back and tap the financial markets, to be able to have a consistent stock price. And I think shareholders in the markets expect a lot more from a board today in terms of credibility than maybe they had before.
Yeah. Let me try and boil that down into even more specific question relative to what a board member should be tracking. I mean, stock price. A lot of companies don't want either their employees or the directors looking at it daily because obviously it's going to swing around, particularly in today's time. But if you had to answer the question what a director should be tracking relative to the capital markets, not counting their stock price, what would your answer be?
Well, I believe the fundamental role of a director is to be able to focus on long-term shareholder value creation, first and foremost. Value creation isn't in just watching the stock price, of course, but having that long-term focus really then necessitates a need and understanding of long-term strategic direction, number one. Probably number two, understanding again from a long-term perspective, what is the current makeup of your shareholders today? Do you understand the issues? Are you communicating with them? And probably number three is really, stock price is more of a relative reflection of value today. A company really needs to understand how it's performing relative to its peers and to its industries, much more so than just the individual stock price. So I think those are the things that I would be focused on.
Yeah. You had mentioned in your first response credibility. Obviously, the corporate credibility is critical, element, which I would agree with. What role does a board play specifically in creating that corporate credibility?
Well, we talked a lot about the different roles of shareholders, management, boards. Clearly, it's management's responsibility to execute on the business, communicate directly with shareholders. But a board plays a fundamental role in management succession, setting of long-term strategy, and look at the litany of cases you've seen over the last 6 months where boards have been asleep in terms of CEO succession, management issues. Sometimes there's been shakeups in companies that were directly related to a board not communicating well with one another. And so I think then you really get into board structure, board communication, strategy, which are all very, very important things. And a board has to be able to project itself at certain times to say, hey, the board does have control over what's happening at the company. And typically I think you see that maybe most in issues around management succession. And if a board has done their work there, those transitions can be seamless and in fact increase the level of confidence that shareholders have in a well-governed company.
That gets to sort of a key word, which I think is culture. And we've talked about a lot on this show of how there are watershed events, within a company's history that the board can help establish that culture. And it sounds like all the issues that you talk about sort of wrap up into the idea of culture as well.
I think, when I travel to places outside of the U.S., the thing that I probably talk most about in terms of culture is really being able to establish a culture of transparency. And when you think about transparency, that's a very difficult concept for a lot of places outside of the United States. We're much more of a disclosure-based system anyways. But in other countries, that's not necessarily the natural flow of things. But I think a board needs to be very transparent with its shareholders, and also be open and listening to what the market and other stakeholders are saying or communicating with a company. And that transparency is very much two-way. And I think when boards are listening, they will have greater credibility.
Well, disclosure is a great segue into my last question about regulation, because it's difficult to talk about capital markets these days or about boards or about business without talking about regulation. So just strictly from the capital market side, how has regulation affected the viability, let's say, of the capital markets in your view?
Well, we're constrained right now as an entire system. Which is we have a series of watershed regulations that have either been enacted, looking at being enacted and implemented. You look at healthcare in the United States. We're now dealing with financial re-regulation, which is Dodd-Frank in the U.S., Basel III in terms of capital requirements for financial institutions. These are watershed regulations. And we just actually completed a survey of CEOs of our NYSE listed companies, and regulation was cited as the #1 constraint in terms of deployment of capital, as well as hiring new people. And so I think regulation has caused a lot of just overall constipation in the marketplace itself, and that will work through. I think the other challenge with that, though, is that we live in a time where uncertainty is just part of the marketplace. And so if as a board or a management team we're expecting that either volatility is going to go down or we're going to have less uncertainty in the future than we have today, that's probably not a safe assumption either. So we need to be able to understand how to make investments, how to deploy capital in an environment that is maybe more risky or more volatile. That's where you'll see outstanding returns for companies that are able to take advantage of that. But overall, I'm actually quite bullish about the capital markets in the U.S. We've had $30 billion in IPOs so far this year. On the NYSE, we've had $120 billion in follow-on financing, which is more than we did in all of 2011. So there is access to capital, and companies are doing it. It's just that level of uncertainty is probably higher than it's been before.
It'd be nice if we could see a couple of the corporate earnings come through a little higher in the next couple of days, just to give another confidence boost that we are making progress. But lot to see, what's going to happen relative to that. And it's nice to have your feet on the ground here in the studio. We want to sort of welcome you back, and I thought this was a great topic, and I appreciate you giving insight to our viewers on it. I think it was excellent insight, so appreciate it. And that will conclude this edition of This Week in the Boardroom. We hope you enjoyed this week's show. And join us again next week when we'll take another look at a critical topic that will make you a better board member or committee member. And we'll see you then.
Join us again next week for This Week in the Boardroom, brought to you by Corporate Board Member and host NYSE Euronext, along with Governance Knowledge Partners, the Center for Audit Quality, and Grant Thornton, and contributing partners, National Investor Relations Institute, and the Society of Corporate Secretaries and Governance Professionals.